Hi, everyone. Welcome to our third quarter market update. Unfortunately, as you can see, I will be riding solo once again, as Darren and I couldn't quite link up our calendars. Not to worry, though, the dynamic duo will be returning for our next update. As is customary, first a word from our lawyers, and moving along. The US and global equity markets continued their upward trajectory through the third quarter of this year, bucking the trend of negative seasonality that we typically experience in the late summer months into September. The AI theme, which we will touch on in greater detail, continues to power technology and communication service sectors to new heights. Its effects are also being felt on sectors that we were positive on coming into the year, namely utilities and industrials. These sectors comprise many entities that act as the backbone to facilitate data center operations. Amidst this run, valuations have reignited, now trading at a 1.3 turn premium to the beginning of the year and still well above historical averages. So yes, the market does continue to look expensive, and really by any way you'd like to slice it. Other metrics of valuation, including the cyclically adjusted PE ratio, the Buffett indicator, which takes total stock market value over GDP, all show that we're at elevated levels. Valuations, though, do not have a great correlation to 1 year ahead returns, but it does reflect the continued necessity for earnings growth to continue to sustain this rally. And briefly on concentration, it has abated, albeit ever so slightly. The Mag 7 is now responsible for 45% of the year-to-date returns, with some broadening occurring, but by and large attributed to entities in other sectors that still retain some exposure to the AI theme. The weight of the Mag 7 and Top 10 has also reached historic levels, now at 40% of the index. So, if you've been following our videos, none of what's been presented today regarding valuations and concentration should be new news. But what can we discern from this? I have, in jest, titled this slide Party Like It's 1999. Famously, this is the year that preceded the bursting of the dot-com bubble when the S&P returned 21%. Today's AI cycle, though, is different. It's concentrated and supported by earnings from the big tech, who are far better capitalized than dot-com era entities. As evidenced on the chart here on the right, while extended, valuations still remain below the dot-com peak. The economic backdrop now is also different, with fiscal expansion and loosening monetary policy, in contrast to the tightening cycle that was occurring in the late 90s. Now, that is not to say the current environment is absent risks. While being a significant contributor to U.S. GDP via investment in industrial production, CapEx spending continues to eat up a greater share of free cash flow for the major hyperscalers. At the current pace of capital deployment, the near-term success of the AI cycle will hinge on material return on investment for AI CapEx, which we've not really seen to date. Key bottlenecks, especially on the energy grid, will also play an important role in sustaining the growth that we are seeing. There are also some signs of exuberance analogous to the dot-com bubble, including vendor financing and the circular nature of the AI economy, in which the major players are all relying heavily on one another. So yes, we are likely in a bubble, but as responsible managers of risk, our job that you have entrusted us with is to find the right compensation for the risk that we are taking. That means exposure still to select AI and AI-related entities, but also businesses in areas that we think can succeed without AI. Anyone that tells you how long this bubble will last is playing a guessing game, and we prefer to take a more measured and diversified approach. Moving on now to global equity markets, the relative performance of European equity markets have stalled since the April lows, which is counter to consensus opinion, but certainly a possibility we flagged in our recent quarterly updates. Nevertheless, our long-term opinion on the relative green shoots in Europe and other areas abroad continue to give us greater confidence over a longer horizon. In terms of global geopolitics, we have seen steepening yield curves across the globe in response to concerns on fiscal sustainability and deficit spending. Japan recently elected its first female prime minister, who's viewed as market friendly conservative in support of loose monetary and fiscal policy. France continues to undergo its own political merry-go-round, with a fiscal crisis still looming in the backdrop and the resignation of yet another prime minister. Thankfully, they only contribute to 1/5 of the Eurozone economy. We continue to closely watch global geopolitical developments to gauge their impact on markets. Moving along now, we're going to spend a little less time on US tariff news, which hopefully is a welcome reprieve. There's really not been substantial developments on that front since we've last spoke, as there's been few country-specific quote-unquote deals reached since then. And Section 232 tariff investigations are ongoing and seemingly never-ending. We have seen select announcements of some obscene sectoral tariffs, of course, with exemptions for companies that commit to building in the U.S. We've also seen a fair share of legal drama, with the U.S. Appeals Court ruling Trump's tariffs as unlawful and unconstitutional. It is likely that these tariffs will remain in place beyond the October 14th deadline until the Supreme Court decision can be finalized. There are other avenues, though, for Trump to accomplish his tariff mandate, including via Section 301's national security tariffs and Section 122 section balance of payment tariffs. So while we wait for the Supreme Court decision, it should be known that we don't think tariffs will fade away in any scenario. And as we can see, they are at elevated levels, especially compared to history, and are likely to remain elevated. Onto U.S. inflation trends. Still, we are seeing some continued pass-through of tariff-related costs, as evidenced by the rise on the chart on the left in core inflation, particularly goods side inflation. So while the inflationary aspect of tariffs is likely to be in the form of a one-time price increase, it will take effect over many months as firms continue to work down old inventory, supply chains adjust, and firms eventually respond via higher prices, which appears to be the path as indicated via both survey data and management comments on quarterly calls. All this entails that inflation continues to show signs of stalling above the Fed's 2% target. And on to now the second part of the Fed's mandate, the labor market. We've been flagging for months that the advanced data was pointing to a decline in private sector employment, and only when that showed up would the Fed be in a position to cut rates. Well, it's here. The labor market is very clearly slowing. Demand for labor, whether measured via openings or quits rates, continue to decline. Advanced data, as we can see on the chart on the right here via Indeed, continues to point to a downward trend. On top of that, the Conference Board's latest consumer confidence report revealed that finding a job is increasingly challenging. So while this hasn't materialized yet in a marked uptick in unemployment, we are straddling a very fine line between declining labor demand and an outright contraction in employment. And so here comes the Fed, hopefully not too late and in a position to rescue the economy. The inflation mandate, which we noted is still above target, is no longer the main focus at this time, which means stagflation is a real and likely underappreciated outcome. Nevertheless, the Fed is concerned about supporting the full employment side of its mandate and appears poised to meet the market's expectations and cut an additional 2 times this year. As always, we are going to continue to carefully watch the employment and consumption side of the picture to gauge the effectiveness of these cuts and the ultimate direction of the economy. And briefly, onto the government shutdown, our first in 5 years. In actuality, this is not something we should be overly concerned about. The market tends to look through these events as near-term noise or volatility, given the expectation that eventually, as there always has been, there will be a resolution. The last 4 times this has occurred, it lasted 18 days, and as we can see on the chart on the right, it has not impacted the ultimate direction of the market during these shutdowns. Shutdowns are frankly a core use of political capital for either party, and they should be incentivized to find a lasting resolution. On now to Canada. We've been fielding a few comments on Canadian tariffs, and so I wanted to just dedicate a couple minutes to that. So let's just review the state of play. The relationship between Trump and Carney appears amicable, and while some patience needed to be exercised, it does appear now that Canada is reaching a favorable resolution, which we foretold in our videos dating back to the beginning of this ordeal in March. The reason we've had confidence in a relatively more favorable resolution is not solely on the backs of comments made by Trump and Carney over the recent days and months, but given the USMCA provisions, the scope of tariffs on Canadian goods is limited relative to the levels that we see elsewhere. As we can see on the charts presented, the actual effective tariff rate on Canadian goods is estimated to have been below 3% in recent months, well below economists' estimates of 7-8%, which, if we're being honest, even in a worst-case scenario, is far below other deals with developed economies. Moreover, we see from the chart on the right that over 90% of exports that include energy, aluminum, and vehicles are not currently subject to any tariffs given USMCA compliance. So while we will wait on a formal announcements from both leaders, we are expecting some finality here shortly. USMCA renegotiations into 2026 are then expected to be the next driver of export uncertainty as US, Canada, and Mexico look to establish a new framework. However, with the tariff backdrop finding a resolution, hopefully, let's look towards now the Canadian economy. As we've previously highlighted, the outlook for employment in Canada remains weak, evidenced most predominantly by hiring intentions. This has fed through to the unemployment rate, which continues to rise and we expect will rise further. The inflation picture Canada is less of a concern now, in our view. With the recent removal of Canadian counter tariffs, that removes a key upside risk to inflation outcomes, and the slowing labor market should keep a tamp down on services prices. We expect core inflation to begin trending back to the 2% target by mid-2026, given the current economic backdrop. Speaking of that backdrop, GDP contracted by an annualized rate of 1.6% in the second quarter, as tariffs and tariff-related export uncertainty have taken a toll. Survey data, including business and consumer confidence, coupled with a weak labor picture, pose additional near-term risks to GDP. This is not a surprise to us, as we've long held the belief that the Canadian economy was left more vulnerable coming into this year than the US. Now, it's not all bad news. Canadian equity markets have now followed the economy with strong gains in financials who've shown resilience and strong credit performance, as well as the materials sectors. The Bank of Canada also appears poised to continue to step in to support the Canadian household through additional monetary easing. We continue to forecast another 1 to 2 cuts to end this year. We've also got a fiscal package and budget that is set to be ginormous. We're going to be sure to dissect that in full in our next update once it's released. As far as the Canadian and US dollar relationship, it's remained relatively range-bound with some recent weakness. With a converging rate path now with the US, we're not expecting significant currency movements at this point in time. From May to now, we've operated within a fairly tight band, hitting lows of 0.715 CAD over USD and highs all the way up to 0.74. And we expect this type of range to continue in the coming months. So with that, I just wanted to thank you, as always, for your time and attention today. Darren will be back with me as we present our year ahead outlook in January. In the meantime, do not hesitate to reach out to myself or the team with any questions.